Bitcoin is stalling at 70,000. The market is pivoting to AI, and BlackRock's $247 million move sparked a textbook reversal. What do the three major signals reveal? It's Thursday, February 12th. I'm Michael for BTV. Here is the key data from the past 24 hours. Recently, the market may appear calm on the surface, but underneath, it's a turbulent storm. Although the price is still hovering around 67,000, short-term volatility has already exploded for 7 days straight. As you can see, it has surged directly to the highest level in history. This isn't a normal fluctuation. The market is rotating assets and shifting rhythm. Interestingly, crypto's long-term volatility hasn't followed suit, and the ATR hasn't expanded much. This shows things aren't chaotic. Undercurrents are simply surging beneath the surface. So what's going on? The market atmosphere is starting to get tense, but it hasn't reached the point of panic or chaos yet. This stage is the easiest to misjudge. Some people think a trend is emerging, while others believe it's just noise. But what we really need to focus on isn't whether the price is moving, but in which direction it's moving. If both the range and the medium to long-term volatility start to rise together, that's the real signal that a major market move is coming. Otherwise, it's just more choppy, sideways action. This is a psychological battle. Most of the time, the market doesn't give you a direction first, it gives you a mood. Today, let's look at a new indicator called the Power Law Divergence Indicator. Simply put, it measures whether Bitcoin is expensive or not, and whether its price is out of line. The higher this value is, the more it suggests the market is overheated. Conversely, the lower the reading, the closer the market is to being out of favor. During this recent downturn, we saw this indicator plunge all the way to -95. Such a level is quite rare in history, so the current situation is similar to the market conditions at the end of the 2022 bear market. Of course, this doesn't mean that prices will immediately bottom out and rebound. The market is never that kind. But this kind of toxin often appears when everyone is most pessimistic and prices are most compressed and undervalued. In other words, prices may not rebound and take off immediately right now, but valuations have already entered a typical discount zone. This is like setting up an entry point for patient capital, while at the same time providing an exit stage for those short-term traders chasing market sentiment. Looking at the economic data from the US, there are some signs of a cooling off package. Retail sales have missed expectations. Wage growth has also started to loosen, and manufacturing employment is beginning to decline. Simply put, both consumption and the pace of making money have slowed down, so cyclical industries are already showing signs of contraction. If we put Bitcoin into this broader macro environment, what does it look like? It's like just catching its breath in the midst of a bear market trend, so we shouldn't expect an immediate turnaround right now. The bearish logic hasn't been withdrawn in terms of direction, but the market is especially sensitive to liquidity and financial conditions, and even the slightest disturbance can amplify volatility. What's even more subtle is that the Coinbase premium has remained in negative territory, indicating that buying interest from the US is weak and prices are mostly being propped up by derivatives. That's why, historically, bull markets have always been driven by both a return of premium and a revival in transfer demand happening together. So right now, the market is still far from reaching that point. Watch for demand returning, not just rising prices. Otherwise, rebounds may be technical corrections rather than true recoveries. Like and subscribe for more. To our new followers, we simplify daily Web3 news for you and help enhance your market understanding. Spend 15 minutes daily to gain a new crypto perspective and sharpen your insights on making money in this space. All right, let's take a look at today's news headlines. Let's pay attention to this. If we turn the clock back to 2021, the mining industry back then was completely different from what it is now, like night and day. In 2021, mining machine upgrades and iterations were not happening so quickly, and the competition in computing power was not as intense as it is now. So back then, if you told a miner that one day they would be dismantling their machines to provide computing power for AI, they probably would have laughed it off as a joke. But by 2026, with the explosive growth in computing power and institutions entering the field, things have changed dramatically. The iteration and upgrading of mining machines is also happening much faster than before. So now, after seeing the coin price drop from its peak while mining costs keep rising, many miners are getting nervous when they do the math. That's why you see things like the blizzard in Texas. The shutdown of computing power is just a surface-level reason. The deeper impact is that the economic model in miners' minds may now need to be re-examined.
Bitcoin network difficulty recently dropped 11.16%, a 5-year record. This decrease reflects the withdrawal of computing power. Older rigs are shutting down as marginal capacity clears, leaving remaining players under greater pressure. This is a typical miner stress cycle. Meanwhile, North American firm Bitfirms is exiting mining to focus on infrastructure transformation. Statements from management have drawn market attention, and signals of industry structural adjustment continue to strengthen.
The connection between Bitcoin and AI is that both technologies require large amounts of energy and electricity, and that's a feature, not a bug. Many Bitcoin miners are sitting on massive reserves of electricity at very cheap long-term contracts, 2 or 3 cents per kilowatt hour.
Bitfirms isn't alone. It signed a $9.7 5-year AI cloud deal with Microsoft, and its valuation now focuses on AI HPC. Core Scientific holds $8.7 in HPC contracts and is adding $100 million capacity in Texas. Industry trends are changing, shifting from computing power and authority to computing power and services. GPUs are gradually replacing ASICs, the data center model is strengthening, and tech giants are becoming the core demand drivers, leading to a structural shift in mining industry logic.
What about this computing power shift? Short-term, miners just calculate ROI. With Bitcoin prices falling and hash rate competition flatlining, we still face another halving in 4 years. Everyone is calculating whether their mining machines will still be able to operate normally 4 years from now. So when these valuations shift from block rewards to your computing power contracts, ASIC chips will pivot toward mining, because the profit margin for AI computing power is actually higher than mining Bitcoin right now. But this doesn't mean that Bitcoin will lose its computing power. Rather, computing power has simply gained more options. The miners haven't left the scene. The market has just redefined what it means to be a miner. When mining machines become servers, people realize that mining farms have essentially turned into data centers. The old narrative of burning electricity solely for the network is being replaced by a more rational and realistic logic. So in essence, computing power is a kind of asset, and assets will always flow to where the returns are higher. So what could replace Bitcoin mining or even surpass AI chips in providing computing power? I'll tell you in a moment. All right, we've been busy with the Hong Kong Consensus Conference these past couple of days, and in fact, we've overlooked some textbook-level reversals happening in the market. How should we understand this? Let me tell you a story. 3 days ago, an on-chain monitoring platform called On-Chain Lines dropped a bombshell. Bitcoin and Ethereum worth $247 million were transferred from BlackRock's address to Coinbase. How do people interpret this? Obviously, it must mean they're about to dump and sell, right? So the market reacted first, and the price of Bitcoin was suppressed to around 60,000. So did Wall Street's referees really step in and dump the market this time? Just as the market hadn't had time to digest the panic that the giants were about to lead a sell-off, the plot suddenly reversed. On February 11th, BlackRock announced that it had purchased Uniswap's platform token Uni and listed its tokenized fund build on Uniswap. So just as the previous move was interpreted as a signal to dump, the next moment it turned into a real money entry. So you see, the biggest danger in the market right now isn't volatility, but thinking you understand what the giants are doing.
Breaking down BlackRock's moves, the signaling is clear. The first step is buying Uni, which symbolizes their first holding of a mainstream DeFi governance token. It's about the gesture, not the scale. The second step is listing the video on Uniswap as a compliant asset, bringing it into a decentralized liquidity scenario. The third step reflects a shift in roles. When institutions simultaneously have governance exposure and asset participation, meaning they both hold tokens and use the platform, the power structure of the platform is no longer entirely neutral.
Many people are just focused on Uni's price increase, but on our show, we want to clearly explain the signals behind it. Think about it, everyone. Once the giants enter the scene, this token is no longer just a voting tool within the community. Its valuation logic will depend on how institutions assess its value, which is a different perspective. To put it plainly, this token will gradually take on the characteristics of a financial gateway, rather than just being a governance button on the blockchain. In the long run, its significance lies in the fact that institutions become both holders of tokens in one hand and holders of assets in the other. They are not only participants in the rules, but also providers of resources. I think this overlap of two roles is a very subtle matter. So, when both governance rights and liquidity gravitate toward institutions, shouldn't the story of Uniswap's decentralization be subject to everyone's scrutiny? Trading volume has been cut in half, yet gold tokens have soared. What signals are hidden in this period of market calm? Earnings reports are in the green, but stock prices are plunging. Can Robinhood really succeed by switching tracks to tokenization? I'm in Hong Kong at the Consensus Conference, where many industry heavyweights and leaders have shared their expectations for prices. The most pessimistic are predicting a number starting with 3. If Bitcoin starts at $30,000, do you think real money will come in to buy it? Let me know in the comments. But today, let's take a look at this. What noteworthy signals did user data this organization provide regarding the crypto exchange industry in January of this year?
This January, global crypto exchange data dipped, with trading volume at $1.2 trillion, down over 50% year-on-year. Total market cap fell to $2.57 trillion as new listings slowed, with major platforms launching only 26 coins. New coin prices and market activity fell, weakening capital risk appetite.
I think you're seeing a lot of, like I said, a lot of people building in this space. So there's a whole bunch of pent-up creation happening right now that's going to meet the pent-up demand, hopefully in 2026. So I'm pretty excited about it. I mean, Binance is one of the biggest names in crypto. It's huge.
Sector performance varies. Tokenized gold trading surged against trends, with PAXG and XRT hitting $32.88 billion in monthly volume, growing significantly. Exchanges are expanding these products as safe haven capital flows strengthen.
During this round of market correction, have you noticed that all the major exchanges, at least the top dozen or so, have made deleveraging and increased compliance their main themes? The competition among exchanges is no longer about scale or user growth. Binance continues to dominate the trading landscape and has made expanding into traditional financial products its main focus. Bybit, HKEX, and Coinbase are all accelerating their compliance efforts and diversifying their business layouts. Git has managed to grow against the trend and has even brought AI tools to the forefront. While the market is cooling down, the industry is quietly shifting gears. When things are lively, everyone focuses on price movements. When things calm down, it's about who reshuffles the deck most skillfully. So in the long run, this round of adjustment may not be a bad thing. The intersection of tokenized assets and traditional finance might just be the real highlight of the next wave of exchange reforms. Robinhood is a force to be reckoned with among American exchanges, with most of its users being young people. In the past, it was criticized for having a thin order book and insufficient trading depth. However, after recent improvements to its system, its financial reports have been very impressive. But the stock price doesn't seem to be cooperating. However, everyone should remember that when the market cools down and prices fall, that's when it's clear who's swimming naked and who's wearing pants. So now Robinhood is planning to make some moves.
Robinhood's Q4 net income hit $1.28 billion, a record high, up 27% year-over-year, though it missed estimates. Crypto revenue fell to $221 million, weighing on shares after hours. Full-year revenue and profits still grew. At the same time, Robinhood launched the Robinhood Chain testnet, an Ethereum Layer 2 network built on Arbitrum, focusing on 24/7 trading and tokenized assets, and made it clear that there are currently no plans for a native token. The mainnet is expected to go live within the year.
They see significant and tangible advantages for themselves and their valued customers. And we're also actively offering unique investment opportunities and exposure to private companies through various other channels in the US as well. For example, consider Robinhood Ventures, which we officially announced to the public just about a week ago. Consequently, Robinhood is definitely going to be a dominant and pioneering force in the future of private markets.
Robinhood's direction is also the direction of all major exchanges. When you look at tightening revenues and falling token prices, it's clear that just relying on order matching has a very obvious ceiling, right? Even if you can bring ETFs and traditional assets on chain to bypass the old problems of slow clearing and high costs. But when the system gets busy, it still feels overwhelming, so building their own highways has become a necessity for all major exchanges. Look at Coinbase building Base, Kraken working on Ink, and even eyeing tokenized stocks. Everyone is moving in the same direction. Infrastructure, to put it plainly, just relying on intermediaries and order matching is getting harder and harder, while building roads, building highways actually offers more room for imagination. After all, it's a two-way toll, right? All right, let's look at the news flash.
From writing champion to falling for the protagonist, the plot twist only took a few days. Bubble Maps pointed out that Vivid, the $1 million writing contest champion on X platform, was intensively launching tokens and cashing out on pump.fun. He made over $600,000 and the onlookers all came online together. Weishin put it quite bluntly, if you want to catch the AI wave, just changing your logo is not enough. The market is never short of new stories. But what's truly scarce is foundational capability. Copying solutions is easy, but redoing the architecture is what's hard. To put it plainly, AI isn't just about slapping on a label. It's about a system-level upgrade. Uniswap has gained the upper hand in the patent battle. The judge ruled that the AMM pricing mechanism is an abstract concept and cannot serve as the basis for a patent claim. In the DeFi world, code can be open source. Yet concepts are hard to monopolize. While the market remains in a volatile phase, DDC Enterprise Limited continues to increase its Bitcoin holdings. This week, the company purchased another 100 Bitcoins, bringing its total holdings to 1,988 Bitcoins, with an average holding cost of $85,756 per Bitcoin. Buying for 5 consecutive weeks, the pace itself has become a signal. When the market experiences sharp volatility, it's often not the price, but the platform that sounds the first alarm. Suddenly hitting the pause button on deposits and withdrawals immediately puts the market on edge. Because in this industry, restricting withdrawals is never just an operational adjustment. It's more likely to be interpreted as a sign of tightening liquidity.
All right, if you have been following our spot trading, you will know that after we sold at the top, we have basically stopped trading and are just waiting for that bottom fishing signal. So, in the 2026 market, what most easily misleads retail investors is not the wild ups and downs, but rather the illusion that you are constantly making moves. Many accounts are unusually active, with positions changing frequently and trading records densely packed. However, the net asset value and withdrawals are almost flat. So, frequent switching of positions and constant tinkering every day does not necessarily improve your win rate. Most of the time, it's just using action to cover up your unease, using trading to relieve your anxiety. The market never pays for your sense of busyness, but it will precisely calculate every impulsive move you make. More trades do not necessarily mean more profit, but they almost always mean you'll pay more in fees. Slippage and emotional drain, these will quietly eat away at your profits without you even noticing. You should know that the sense of security brought by frequent trading is often just the beginning of a slow drawdown. In the most uncertain environments, doing less is harder than doing more, but it gets you closer to the essence of survival. If you understood this, feel free to give a like. That's all for today's program. All of this is part of our membership benefits. We hope to work hard together with everyone and gradually become wealthier together. See you tomorrow.